TowneBank Mortgage is an equal housing lender. NMLS number 512138. This is not a commitment to lend. Welcome, everyone, to the December edition of Wilmington Mortgage News. I am your host, Tyler Cralle, and with me, as always, is the Eastern North Carolina sales manager of TowneBank Mortgage Wilmington, David Macaione. And David, thanks for being here, as always. Appreciate it.
Of course. Good morning, Tyler.
All right, so just to get this out of the way, we got to do the compliance issue. My NMLS number, I almost said David's. It's much shorter than mine. My NMLS number is 202-8201, and David's is 117378. So we are recording this on Thursday after the big Fed meeting, or I should say the announcement from the Fed, and that's what everyone is talking about. We've had time to digest what was said, and immediately after the press conference, the word everyone was using was hawkish. And David, it doesn't feel like anything has changed since then. It's still pretty hawkish.
No, it was as hawkish a statement as they could have done. I mean, I forget the numbers, but I think 17 Fed governors all went from a ending Fed funds rate below 5% to above 5%, and 7 actually went above 5.4% by the end of next year.
Yes. What was interesting to me about it was everyone said, okay, we knew it was going to be 50 basis points.
Right.
So that was not all that surprising. But what surprised a lot of people was sort of, I don't want to say pessimistic, but like maybe a more realistic sort of look at the next couple of years, in that we're going to see interest rates higher, we are going to see inflation higher, and we're going to see GDP growth a little lower than what maybe some people were thinking. And so anyone who was under this idea that we were going to return quickly to the sort of pre-pandemic norm of, very low Fed funds rate and very, very low rates, probably not in the future.
I think the Fed's trying to dispel that myth.
Yes.
Because a lot of people really believe that. And I mean, clearly yesterday the message was just the opposite. And I'm looking right here at Fed funds, at the S&P is getting crushed by it. Interest rates actually have gone down. The 10-year's gone down a little bit since the meeting. But I think that's just, it's trying to find its way. Well, I think the 10-year doesn't quite know what to do yet.
And I think that's important because there is sort of this perception that the Fed funds rate immediately impacts mortgage rates. And that's not true. And so a lot of people want to know, that's probably what they're wondering, is that what is yesterday's meeting going to do with regards to mortgage rates? And what's funny, pointing out that we're seeing the 10-year drop, which usually is a good sign for mortgage rates moving in the right direction for most people.
Right. Well, there are times where the Fed funds rate is moving up and mortgage rates are moving down, or the 10-year is moving down. And there are times where the Fed funds rate is moving down and mortgage rates are moving up. And that's, the bond market tries to anticipate what's going to happen sometime down the road. So the bond market, I think, is trying to anticipate the end of the Fed rate hikes. I think that they're a little bit premature, probably, given yesterday's statement by the Federal Reserve. We know the Fed is going to probably raise rates two more times, maybe 2 quarters. Then after that, I think it's still unknown. I think it's, again, just like our first episode that we did. You tell me what's going to happen with inflation, and I'll tell you what's going to happen with interest rates.
Well, so this is the median projection from the Fed meeting. So this is kind of taking everyone what they think is going to happen, all the members of the committee, the Federal Open Market Committee, and they believe that the Fed funds rate is going to peak at 5.1% sometime next year. They believe it will remain above 3% all the way through 2025. So that means we have at least 75 basis points more to go before we reach that peak that they think. And that's because you mentioned inflation. They think that inflation has peaked, so that's the good news for everyone. Inflation, they think, has peaked.
The Fed said that?
The Fed, yeah.
Okay.
Because they believe that, or I should say, is that they believe that, for this year, I think inflation averaged about 5-6%. They think in 23, it will remain above 3%. And in 24, it will remain at 2.5, and then it will be at about 2.1 through 2025. So if you look at their projections, they believe that inflation, on average, will be better next year than what we saw this year. And it will get better, but it will remain above 2%, and that's important because that is the target rate. And
Right.
so that means the Fed is, not going to be happy until we get back to that 2%. And they're saying that's 3 years out.
And that's what they've said. They're going to keep going.
Yeah.
I think what did Powell say yesterday? He said it's no longer the pace, it's the duration.
Yeah.
So this is going to go on longer than what a lot of people think. It's just not going to happen at 3/4 and maybe even 0.5% increments.
Yeah.
But think about that: 4 times 3/4 and 1 times 0.5. So we've gone up. That's 3.5%. And wasn't there a 0.25% rate hike before that, or was the 3/4 their first one for this?
I want to say it was the 3/4 because I remember it was like, whoa,
Right.
like they went full steam
So I mean,
ahead.
they've done a lot in a short period of time, and that's what Powell was saying is like, all right, we did a lot in a short period of time. Now we're probably going to do less over a longer period of time. That's how I took it.
Yeah, no, I mean, and so once again, this is the median expectations. So they do think inflation next year will be better. So that's going to be a good thing for consumers, but it's going to be a while, at least in their opinion. Now, of course, once again, this is just their projections, and we all know that a lot of people have reminded us that the Fed did think at one point this was going to be transitory inflation, and now here they are saying we're not going to get to 2% until 3 years out. So they've gone from it's going to be transitory to this is going to be almost a 4 or 5 year cycle of inflation.
I'm a bit skeptical about inflation. You know that.
Yeah.
I think that I've been surprised by how long it took for inflation to come out to get established with the how low interest rates were for such a long time. It finally took the government giving away money due to COVID where it finally pushed the money supply over the top. I just don't think inflation's that easy to kill. I want it to be because I want to see interest rates go down. That's what it benefits us. It benefits me. But I just think everybody's a little bit too optimistic about this being taken care of as quick as, oh, all right, the Fed's raised this much, we're done. And it's just not that way. And so I think the Fed feels that way now too after making the transitory mistake. I mean, now they've made a mistake, so now but the Fed always goes too far one way or the other. They always go too high, too low. It's just been a long time since we've seen them go too high.
Well, and also I think really pushing Powell is, Volcker. Volcker sort of looked at as the GOAT, the greatest of all time with regards to central banking.
Tom Brady of central bank traders.
But people forget that he got pressured politically in '79. You had the March on Washington with the farmers.
Yeah.
And he blinked and he stopped hiking rates. And I think he maybe even lowered rates, and inflation then kept going. And then he said, whoops. Worse. And then he went back to the rate hikes and finally was able to take care of it. And Powell has mentioned that in speeches.
Powell he has quoted Volcker.
Yeah.
So that tells you he's taking this seriously.
So he's like, we're not making that mistake.
Right. That doesn't mean interest rates have to go up as much as the Fed. If you remember, the Fed did a 1.75% rate hike, and all of a sudden interest rates went up, 2-3%, however much they went up. So the bond market anticipated the rate hikes that were yet to come. So the bond market will anticipate the rate cuts that are yet to come. The question is, are we almost done? And that's what I think is unknown.
And of course, we know that the Fed has two mandates, employment and inflation. And so let's talk about what's influencing these reports. And it's important to remember that the Fed looks at the PCE for their inflation data. However, the news media really like CPI.
Right.
And so we just had a CPI report come out, and it showed, and here's the good news, is that it was actually lower. It showed that inflation was cooling faster than they expected, but it was still at 7.1%, which is over 3 times the 2% target rate the Fed would like to see. But it was a good report. The markets reacted like it was a good report. We won't get PCE until later in the month. But we did get 2 decent inflation reports in a row. I mean, still a very high top line number, but for the most part, something that was optimistic, I think, for a lot of people. And that's why you've seen people argue that maybe we have seen inflation peak, and that's why the Fed's projecting that next year inflation will be better than this year.
Right. Well, and what kind of strikes me, what you just talked about, is that we still have all the interest rate curve, the whole curve, from the Fed funds rate to the 30-year Treasury, are all below the rate of inflation. Mm-hmm. And granted, in the last 15 years, things have been a bit skewed because the Fed has kept interest rates so low. But I mean, I remember a time in the 90s and the 2000s, in the late 80s, when inflation, these interest rates, except when the Fed was cutting, these rates all got above the rate of inflation significantly. Right. And so
that'd be pretty crazy right now.
And this is a little aside, but this morning on CNBC they had I think they called him Lord Mayor of London, like the Mayor of London, and he was talking about inflation in Britain and what was different about their situation versus ours, and he said they're having wage cost increases, which if we get that, you can forget about it.
We're seeing a little bit, and people have said that we could be in a sort of like perfect situation where wages are rising. Because we'll get to the labor market. Labor market's still very tight, so wages are rising because people are saying, "Hey, I need money. My food costs, everything's going up in price," with declining inflation, which could be like a perfect little thing. Now, of course, if those get too imbalanced, then we have a problem. But a lot of people have said we could be in a place that's pretty good for consumers because they've been really getting hit the last year with what's happening with inflation.
We were at the Intercoastal Sales meeting yesterday, and Trey Wallace was giving data out. He was talking about the median price of a home and the median income in the area, and how people that were making the median income could not buy a median priced house.
Yeah.
And I don't know if that's exactly a great comparison, but using that, he said something's got to give, and he said that interest rates would have to give, or housing prices would have to give, and it immediately struck me. I thought, wait, there's a third wheel to that, and that is wages could increase.
That's true.
And that's the thing that the Fed really is concerned about.
Well, yeah, that's referred to, I believe, as the wage price death spiral.
Right.
Because what ends up happening is that wages increase, and then because companies are spending more money on labor costs, they have to then raise their prices, and then as prices go up, people demand more money, and then wage increases, of course, in theory, sound awesome, right? Everyone wants to make more money. But there's the other side to that, right?
Yes.
It's sort of
like... It becomes part of inflation.
Yeah, in economics, there's always like an equal and opposite reaction to something that is happening in the economy. And let's talk about the labor market here real quick, because this is the one thing that has really, I think, been driving the Fed, specifically Jerome Powell, I think, kind of crazy. Here they've been raising rates at a very quick pace, and they're hoping to see some loosening in the labor market, because that is what they're concerned about, is wages starting to rise. And we haven't seen it. This last report that we got for the month of November was supposed to show 200,000 jobs. We actually saw 263,000 created. And it just seems like we can't find a way to cool off this labor market.
Well, they keep raising rates that eventually
will. Yeah, eventually.
Well, they've said it. They're willing to see a 5% unemployment rate, which, if I go back to the beginning, when I say the beginning, my experience in the mortgage industry, that was 1985. I've seen a 5% unemployment rate many times. I think I've seen close to 7%. 5% sounds high because we've been in the 3s for a very long time. But the fact that the Fed is willing to take a 5% unemployment rate, I think it tells you how serious they are about this and how serious they are. I think that's the thing that they're not openly talking about, is wage pressure. Because if we get wage pressure, then inflation is going to be a real bear. Yeah,
I mean, it is interesting, and it's unfortunate because everyone wants to see inflation go down, but no one wants to see unemployment go up. And because we're talking about people losing their jobs, no one wants to see that. And so I understand the hesitation among a lot of people. And it's very weird because it's like every month we watch this report and we're hoping for a low number, and this great number comes out and people say, isn't it weird that we're all supposedly cheering for a bad jobs number? And it does feel kind of weird.
It does.
But that's just the reality of the situation.
That's always been the case. Bad news is good news. General bad news is good news for interest rates.
Yeah.
But, the good thing is the Fed has made it very clear they're not stopping until inflation turns. Mm-hmm. And so that's a good thing. I mean, there are people out there that think the Fed should be cutting right now. Jeremy Siegel was on this morning on CNBC, and for those of you who don't know, he's a Wharton professor. He's considered a stock guru. He thinks that the Fed will be cutting interest rates by the middle of next year. That'd be awesome, because that means inflation's coming down. But I don't think he cares about that. There are people out there that don't care about inflation. They just think that cheap money can go on forever. And inflation is proof that that's not the case.
Yeah, the more academic, I think, the more you kind of get removed from what's actually happening and who's being impacted by all this. Before we close things up, I did want to just talk about the latest Case-Shiller report, which, just a reminder, this is a lagging report, so we're talking about home prices in September. But more than likely, this report came in, we got this last month, the end of last month, and it showed that home prices year over year were up 10.6% in September, for I think 2 or 3 months, we've been seeing home prices fall month over month. So more than likely, we are going to see the next report will probably be in the single digits. So a lot of people who've been worried about these home prices that have just been skyrocketing, at least nationally, we are starting to see things cool off rather quickly. I mean, we pretty much every report is sort of a record slowdown. So as quickly as they rose up, they seem to be slowing back, and we're getting sort of back to that kind of baseline.
Well, I agree with that, probably nationally, but I can tell you locally, anecdotally, we have a client right now who bought a house without having sold her current home. They put it on the market about a week ago, and now yesterday they called me because they were wondering whether they should accept a USDA offer or a conventional offer. Well, I told the USDA offer was full price, and we all know a year or two ago that you would have a hard time getting a government, FHA, VA, USDA loan accepted, an offer accepted when there was a conventional offer on the table. But in this case, the conventional offer was lower, and then the conventional people came back full price, but I believe they already accepted the USDA deal. The point is, $325,000 house got 2 full price offers. So in this town, I hate to say it, but $325,000 is what you would consider to be affordable housing.
Yeah.
And when an affordable house in the right neighborhood comes up for sale in this town, there's still multiple offers at full price. So maybe 700, 800, $1 million and above, they might see some froth taken off the top. But a house that the average person can afford is still selling when it comes on the market. There's just not enough of them, and there's not enough people out. We're just seeing it at a much slower pace than last year.
Yeah, I mean, what's amazing about all of this is there's one company who does weekly data looking at housing inventory, and Altos Research, pretty great outfit. They actually just got bought by Housing Wire.
Right.
They, for the last 5 weeks, have reported that housing inventory nationally is on the decline. I mean, so that's what's blowing people's minds, is that everyone a year ago was projecting that once things slow down in the housing market, you're going to see this explosion of homes hit the market. It's not happening nationally, and it is definitely not happening in
Wilmington. It's because people are taking their houses off the market.
Yeah,
it's not because they're selling.
Yeah.
Right. So, well, we're going to see. That's going to be interesting. Spring's going to be interesting.
All right. So because this is the last episode of the year, we talked about the Fed predictions. You think anything you think is going to happen that maybe people aren't talking about that's going to happen with housing or mortgage rates or whatever?
I think people are, as long as rates stay somewhere where they are, near where they are, even to the peak that we saw, mid-sevens, I think that there's a lot of people out there that need to buy houses, and I think that come springtime, whether rates have come down or whether rates have held steady or found a range between, say, 6 and 7.5, I think that people are going to start buying houses again because there's so many people out there that need to buy houses. 2 of my adult children have yet to buy houses, and they need to. And they wish they missed the boat for various reasons, like not knowing exactly where they're going to live. But the point of the fact of the matter is, there's a lot of demand out there that is just taking a break.
Yeah, no, spring could be very interesting. I think.
It will be.
I think a lot of people are under anticipating what's gonna happen in spring. I think spring, it's not gonna be like the craziness that we saw the last 2 years, but I think it's gonna be a little better than normal spring, more than likely.
And I think that you and I have talked about it. I think there's just going to be a smaller pie divided up by a lot less people. I think that there's going to be a lot of. It's been too easy for the last 14 years for people in our business, and it's been too easy, especially in the last 2 and 3 years. So I think a lot of folks had success because how could you not when interest rates were at 2.5% and we've had the hottest real estate market that we've ever seen. We're going to see a lot of fallout. It's already started to happen.
Yeah.
But I think come March, April, there's going to be a lot less, not only mortgage companies, but licensed loan officers.
A resizing of the industry.
Exactly. So that's why you need to work at Town, because Town's solid. We're going to be here through it all.
Yes, that is true. And so I guess let's close things out. Once again, if you guys have any questions, you can talk to us here at TowneBank Mortgage Wilmington. Go to TowneBankMortgage.com. You can reach out to David or any of the other loan officers that we have here at Town. And hope you guys have great holidays. Enjoy your Christmas. Enjoy your New Year. And we will talk to you in 2023 and hope that all of our predictions come true.
Merry Christmas. Happy New Year.